Hi everyone, Mandilaka here. Welcome to our YouTube channel once again. Thank you so much for joining us. Thank you for your engagement of our content. We are seeing the interest that people have been showing. It's encouraging and it helps us to continue to bring you more good information that helps you become better with your finances. Today we are planning to talk to something that I've already touched on in my TikTok account as well as my Instagram and Facebook, and that is helping employees grow their wealth without putting too much effort on it. How do we go about doing that? And trust me, this is not a trick. It's not me trying to give you something that you might be caught out on later on in life. This is a principle that works, and most people who have understood these principles earlier already in life, they made use of them and they became wealthy without much effort. One of the things that is happening at this particular point in life is that the economic demands for our generation are quite steep compared to the economic demands of the generation before. That tells you that a whole lot of things that we are paying quite handsome amounts in this day and age are things that our parents and people before didn't really spend so much effort and resources to get them. And that means that our strategy and our approach to how we are going to get the very same things to just keep abreast in life are going to take us a little bit more effort than they did our parents. So how do we go about then ensuring that we apply principles that are that they transcend time, they transcend ages, and they actually still help those who observe them in order for them to fare well with regards to their finances. It's mostly if they're employees. I'm not going to touch on a number of other aspects that are distracting my mind right now because things have changed. For example, things that were benefits for the previous generation, such as your guaranteed benefits, which has changed to being a matter of guaranteed contribution, has altered how employees at this particular point have to approach their financial well-being and also how they prepare for their pension or retirement age. How do you do that? The first thing is you need to understand that whatever you will be getting and at your retirement age will be based on what you are contributing during your employment season. So from the day you start working for an employer to the day you retire, because of at that particular point, whether it be because of you are feeling that you no longer have the strength and you don't have the will to actually continue, then you actually decide to retire, or it might be superannuation or health or whatever the reason might be. At that particular point in time, you will actually get out as a payout amounts based on the contributions you have made. So it's not one size fits all, which is what used to be back in the day. As long as you've worked for a particular department, they would guarantee you benefits that would take care of you until you die. At this point, if you do not contribute enough to sustain yourself for the remaining years of life after your employment life, you might struggle and have to find a job post 60 and 65 years of age, which is never a good picture unless one is doing something they really love and that makes them feel alive. To such an extent, retirement is not an option for them. So let's then look at the options or the principles that you can put in practice that can ensure that when you go to retirement, you're well taken care of. Firstly, we look at what you are contributing already through your employer, which is your making use of your pension, retirement, and your provident funds as contributions that can grow your investments and in return grow your capital growth, grow your interest earning, so it'll be interest, it'll be dividends, and as well as it'll be your capital gains without them being exposed to taxes. What do I mean by that? Firstly, we know in South Africa that we have provisions in the Income Tax Act, which are in your Section 11, capital letter F, where you are able to make contributions towards your pension up to 350,000 rands of your income, and it actually we're using 27.5%, but then we cap it at 350,000 rands. Now, if you make that contribution, and this is normally relevant for people who are in the high income brackets, for example, your 41% and your 45%. Let me also make this disclaimer: this is not financial advice. This is just financial literacy to enable us as employees to know how to make the best use of our money. Now, we go back then to the principle. Now, if you are contributing towards your pension, retirement, or your provident fund up to that 350,000 rand, SARS is saying they will give you full deduction of that money. Now, your employer calculates your pay as you earn, which is the taxes that are deducted on your pay slip, based on the based on the employer's contribution. Let me just reiterate this. So your employer or your payroll section at work, they calculate your pay as you earn on your gross income or on your pay slip amount, which is, it could be a cash component, based on what is predicted at the beginning of the year. So they annualize what your cost to company is, and they put a percentage of your contribution towards your pension, provident, or retirement annuity on a monthly basis, and then it actually gets to a certain amount annually, right? And that amount could probably be, it could be 10%, it could be 15%. It does not get to that 27.5%, neither at times get to the 350,000 rands. So that means the deductions on a monthly basis are going to continue, but you will be able then to claim from SARS the additional contributions that you will be making towards your retirement, pension, or your provident fund contributions over that particular year, which then gives you a refund at the end of your tax period. Right, so that's the first return, because you then get a refund on an annual basis for every additional rand that you are putting in towards these three pension amounts that I'm actually talking about. So that means you will definitely see a cash return, and we can actually put a percentage on that against the income that you are earning. All right, so the second thing, and I know most of us are always worried about the take home if we increase our pension, provident, or retirement annuity contribution. Now, I want to awaken you to this reality. You must take this into consideration. When you think of the effect that your take home is going to have because you've increased your contribution, it will only be the after tax effect. Let's make an example. Let's just say you increase your contributions with 1,000 rands, and you are on a 45%. You are on a 45% bracket, right? Now your take home of that 1,000 rands will be 1,000 rands minus 450 rands. That means your take home will only decrease by 550 rands. Yet your investment contribution will increase by 1,000 rand from your personal contributions. But also, most companies, they have a policy where they match your contributions towards these aspects that I've spoken about: your pension, provident, and your retirement annuity. So that means if you are contributing 1,000 rands extra towards your pension, your pension amounts, your employer says, I will also contribute 1,000 rands. That means your investment towards your retirement is actually going up by 2,000 rands, yet your take home is only affected by a lousy 550 rands. Can you see the cost over benefit? So you are only losing out 550 now, but you are actually going to grow your investment by 2,000 rands. Right? And this exposes that 2,000 rands per month, which then could be 24,000 in a year, to compounding growth, because of you then get that investment exposed to compounding interest, which then means it actually grows upon every growth that it earns. Now, this is a good thing for you to look at, right? I've already given you a few benefits that are already at your disposal by virtue of you doing this. The last thing that I want to touch on when you actually do this right is the fact that you grow your money without exposing its growth to taxes. What do I mean? If you had an investment account where you were putting money for it to have an interest rate growth, let's just say of 10, 11%, right, in a particular year. Now, if that interest that's growing there is accruing to you on an annual basis, it would be subject to taxes. For sure, you would first have the exemption of 23,800 rands that you will have from SARS, according to your Section 10 of the Income Tax Act. However, anything that is over and above 23,800 will be subject to taxes. However, if this same amount of money is put towards your retirement contributions and it grows there by more than the 23,800 rands, it still will not be taxed until you retire. So that means the money that would have been taken from you for tax purposes, which I always emphasize you will never see, is now growing, and it actually attracts more growth for you because you have put it in a retirement, pension, or provident fund investment type. So this actually means that there is more benefit for us as individual when we increase or we max out our retirement or pension or provident fund contribution to that cap of 350,000 rands than we are losing. Then the last thing I want to touch on is after you have maxed that, you can consider the use of your tax-free saving account. Your tax-free saving account is an opportunity for us to invest as South Africans, employed and unemployed, towards an investment that will bring you growth, that will also not attract taxes. People don't understand the effect of taxes on our wealth creation, because one of the things that eats away on our wealth creation are taxes. And I've always spoken about how we as individuals contribute the highest when it comes to taxes. Now, we can do these things so that we can have a reversal on the tax effect concerning our wealth creation or our income earning strategies. So I just want you to actually consider these. And by the way, these are the limitations for your tax-free savings account. You can contribute up to 36,000 rands towards your tax-free saving account in a year. You have a lifetime limit of 500,000 rands. That normally is achieved over 13 years and 11 months. Now, that means whatever growth that you are getting from that 500,000 rands, if you max it, it will be without taxes. So if you get to 10 million, depending on when you started saving towards your tax-free savings account, that 10 million rands will be without taxes. And you want to make sure that you seize that opportunity, because it does not come twice in a lifetime. You can have this for your kids. By the time they finish school, your investments towards their tax-free savings account could fund, we don't really encourage, but it could easily fund their education, and then they could actually find other ways in order for them to generate their wealth. Otherwise, they can keep those tax-free savings account until they are 65 years old, and they could get up to 60, 70 million if ever they leave them in a growing instrument. Hope these are helping you one way or another and that you find them beneficial. Please do share your views and do share your comments in the comment section. We hope to see you in the next episode. And by the way, if you haven't subscribed, please do the right thing so that we keep bringing this content so that you actually also get to grow with us. Mandilaka here. Thank you.